Welcome back to the Everything Property Podcast. For those of you looking to take your property portfolio and journey to the next level, for those that are looking into turbocharging their earnings and capital base faster than your average buy and hold strategy, today's episode is for you. It is no secret that property is a game of finance, but there is different levels to it. Today's level, the intricate world of commercial and development finance. Now, it almost seems like a taboo space, mainly because there's not that much detail and information out there, which is why we're doing today's podcast. Here to help me with this, we have a commercial broker who, for her age, has an impressive rap sheet of awards from Young Gun, Rising Star, and Commercial Broker of the Year. Should I add as well, youngest and first ever female to win such an award? Isabella Constantinou, welcome to the Everything Property Podcast. How are you?
Yeah, good. Thank you. Thanks for having me.
That's all right. Thanks for coming on. So, look, is that did I read right? The youngest and first ever female to win Commercial Broker of the Year?
I believe so. The publication that put the award out said that they can't find it on record anywhere. So,
we'll claim it anyway.
Yeah.
Tell me before we dig into sort of how you won all your awards and your claim and your rise to fame. What was Izzy like back at the days of school or back as a kid? Like what type of person are we talking about here?
I actually used to be a competitive horse rider.
Yeah.
So in high school, that was my kind of niche, I guess. That's what I was doing on the weekends. I did show jumping and eventing. So that was kind of what I was doing when I first started my job at Simplicity. And yeah, that was really my priority. I had no idea what finance or mortgage broking or anything was.
Yeah, okay. So school, what was I feel like when you get into school, when you get into sort of those senior years, you start having to think about and get pressure put on you into like what you're going to do next, what you're going to move into. What was that for you? What were you thinking that you're going to do? Or
I thought of doing a business degree just because I wasn't sure what I wanted to do. And honestly, the writing was my priority at the time. So I couldn't really see past that. So I was like, I'll just go to university, I'll do a business degree and then I'll figure it out. So yeah, I didn't really have an idea of what I wanted to do.
Yeah.
Yeah.
And then you finish school, you're going, the story about how you got that Simplicity gig. Can you tell that a little bit about the job interview and how that happened?
Yeah, sure. So I was, at the time, where was I working? I was working at a tech company in Pymble, which happened to be just around the corner from Simplicity's office. And I was kind of bored of what I was doing. I was working as a receptionist part-time and still doing this competitive horse riding thing. Yeah. And so when I was at my job, I was looking at Seek for jobs in the area. I was like, I'll just see what's around. And Simplicity was actually hiring for an office manager job. And I was like, cool, I'll apply. And if I get an interview, I can just roll down at lunch and go and see what it's like. Yeah. And I walked into the interview and I was like, what do you guys do? I have no idea.
This is your early 20s?
Yeah, this was in my last year of uni.
Yep.
So I think I was just about to do my last exams and then graduate the year after. Mm-hmm. And yeah, so I ended up getting an interview. I walked in and I was like, I have no idea what you guys do. But I'm kind of interested in the role, I guess. It seems like a cool office. They seem like great guys. It was a new business at the time as well. So I don't think they really knew what they were looking for either. And so I got a call a couple of days later from one of the now directors, and he was like, we just don't think it's going to be the right fit for you, the office manager job. We think you're probably going to be a little bit bored. So we've actually just created a role for you. So if you're interested, we have a graduate role that we're happy to offer you. And I was like, sure. What does that look like? And they were like, we don't really know, but we'll just figure it out as we go. Okay. And yeah, so I started the role and I started part-time and I was very clear to them, the horse riding stuff that I'm doing is my priority. So I can only work 3 days a week. Yeah. And then I think within 2 months I went full-time.
Wow. What happened to the horse riding?
I was still doing it.
Really?
Yeah.
Are you still doing it today?
No, not anymore. It's just become a bit too time-consuming and too expensive at the moment.
Okay. Is that I got no idea with that in general, but I sort of played a little bit of sports, so I understand the sacrifice, but is that like an age thing where you really need to sort of be in the right circles and competing at the right level by a particular age. Like obviously, for me it was soccer or football. It's like, you know, in your early 20s you really need to be playing, early to mid 20s you need to be playing first grade. Is there like an equivalent where like you had this little time period that you needed to make, or not so much?
You can do it until you're 60, 70.
Oh.
Yeah, there's not really any, but yeah, I mean, you can do it at any age.
Okay.
So there wasn't really a critical period or anything to be really good at it.
So your focus went from part-time into full-time. You're looking at more so your corporate and career life. What did you, early days in that job, what were you doing? What did they, like, you know, how did you sort of start to grow your experience and understanding in the space?
So for the first 6 months, I really was just a sponge, like, of information. As I said, I had no idea what the business did, no idea what broking was or anything. So I really spent the first 6 months just learning everything there was to know about what the business did, what mortgage broking was, and the different sort of segments in the market. And at that time, I then became an associate for one of the directors, which was a really, really great opportunity because I got so much exposure to so many different deals and so many different, you know, high-profile clients or like mum and dad clients. Like there was just such a wide spectrum of stuff that I was learning. And then, so I was an associate for 3 years, I think it was. And then in 2020, it actually was 2020, just before COVID, I moved into a broking role.
And were you doing resi and commercial then, or just commercial?
I think for the first year of Simplicity when I started, we were doing resi, like a little bit of resi and commercial, but then we stopped doing the home loans, like the regulated home loans, about a year in, just because in our opinion, you can't be really good at both. Like you probably need to pick your laneway.
And did you care that you weren't doing resi and could help any? You'd rather commercial?
Absolutely.
Why? Tell me.
It's just so much more interesting, and I think it's so much more fun.
Really?
Yeah, because it's so dynamic. Every deal is different, and I think in the resi space you don't really get that. Like I really like being able to structure deals in different ways. Yep. Every project is different. Every transaction is different. Whereas I think in the resi space, there's only so many ways you can go.
Yeah, okay.
There's investors, occupiers, but it's all very formulaic, I guess.
Yeah, okay. Interesting. A lot of the people that I as well speak to in the commercial space don't want to deal with the headaches that come with residential and own an ox. Yeah. They feel like the people that are in the commercial space are very just like numbers driven and sort of straight to the point. There's no emotion. It's just based on the numbers and the facts.
It's also really hard to be really good at the compliance side of it. I think if you're not doing it all the time, there's a lot of regulations that you have to follow as a business. And us at Simplicity, we're really just not set up to do it.
Okay, the resi space.
Yeah.
Okay, well, perfect. Well, if people listen to this and they're only used to the resi space and the resi, I suppose, broker space, and they're looking to make that step into commercial, where do we start? How does commercial look like? How's it broken up? Different tiers and that kind of stuff. How would you sort of, in a nutshell, explain commercial and or development finance for someone brand new?
It's multifaceted. And it can be a little bit scary. I think if you're a resi broker and you're looking to get into commercial, it can be quite confronting because there's so many different facets. You've got like your industrial space, your office space, your resi space in terms of like residential property development. You've got asset finance. Like there's so many different aspects to it that I think it can be a little bit overwhelming. But you asked a question about how they would get into commercial.
Well, I guess how it works, because when I'm in resi and I'm looking to buy a home, obviously it's income, and it's basically assessed on income, and if there's any income that's paid by personal income, and it is by the income of that property that I'm buying, right? Mm-hmm. But commercial, I mean, there's a plethora of different avenues that you can go down and that you can use. There's different tiers of lending. Yeah. There's banks, there's non-banks, there's privates. Like, what is, for someone that doesn't know anything about that, what is each of those levels, and what are some of the different ways that we can buy property through commercial compared to resi?
Yeah, so there's probably 3 categories that I can touch on. If you own a business and you're looking to buy a property to occupy your business out of, then it really comes down to the performance of your business, what your financials look like, what your business plan looks like, how much money you have to contribute, and what I guess, what the growth trajectory is for your business and why buying that property is going to be beneficial to it. If you're an investor looking to buy a commercial property, then it really comes down to the yield of the property that you're buying, what the rental income looks like, what the tenancy profile looks like, how long the leases are that are left on the property, and just making sure that the income from the property can support the mortgage repayments. And if they can't, what the income outside of the property looks like. So if you have your own business separate to what you're buying, if you have another property portfolio that's generating income that can help support the debt. And then the third one is the construction space, which I'm in. And like, to be honest, every transaction is different. It's very formulaic from a lending perspective in terms of, running through a feasibility of a project, but every project is different in terms of what's required, because it comes down to what you're building, who the builder is, what your experience is, how much money you put into the project to date, what the purchase price is, and like there's so many different aspects to it.
Yeah, okay. Well, look, let's start us off. If just quickly as well, a question that comes to mind with the business income, right? So no other property portfolios. If I've got a business that is generating income, is there like sort of, when you're buying in the resi space, provided you have no other debts, at the moment I'm seeing a lot of brokers say that current interest rate levels, you're looking at being able to borrow roughly 5x of your current income. Is there anything that transitions over to commercial in terms of your business income and what that can then be used to buy?
It's pretty broad because there's so many options in the market for commercial. You can go, as you mentioned before, you can go to banks, you can go to non-banks, you can go to some private lenders, and every lender tier looks at it differently, and there's different ways that you can assess it. You can use your BAS statements as opposed to financials and do a multiple of them to work out how much you can borrow. You can use your financials and the net profit to calculate your servicing if you're going to a bank, and then there's also like the non-banks and the privates have the ability to use, say, an accountant's letter or a self-declaration of income, which then it's based on an interest cover metric. So however much you declare an income needs to be able to cover your repayments by a certain by a certain interest cover. Okay,
what are some of the pros of non-banks and private lenders?
The flexibility, definitely, and the time it takes to get to settlement. Everyone knows the banks are slow, and it's just the reality of what you have to deal with to get a lower interest rate. The banks are a much more tedious process. There's a lot more information that's required. So to go to a non-bank or a private, you're really getting like the benefit of a quicker turnaround time and the flexibility in the way that you can structure it.
Okay, but then they're charging a higher interest rate. Is your interest rate your only con there? If anyone's considering bank versus second tier versus private?
Interest rate and definitely reputation's probably the wrong word to use for it. There's so many different lenders in the non-bank private space, and particularly as a broker, say you're a resi broker who's dipping your toes into commercial, there's a lot of non-bank lenders in the market that probably don't have the client's best interests at heart really deep down.
Yeah, okay.
And there's a lot of stuff in the AFR at the moment about some non-bank and private lenders coming out not following the guidelines, doing the wrong thing by the clients, and it's you got to be really careful with where you're going.
Yeah, interesting. Okay, I guess the broker's the person that's going to tell me that, right?
Exactly. But if you're a resi broker who hasn't done a lot of commercial, you should be asking probably someone who's in the industry. You should be getting a reference for who you're using if you've never used them before. So who the sharks are. Exactly.
Okay. Well, look, tell me. I want to run through so the audience can sort of get some value from today's session regarding development finance. That's what you're in, about structuring projects and development projects. I guess there's two sort of ways I can think of in terms of needing a loan. That's for the initial purchase, and then it's if someone already owns the property and then wants to do the development on top. But what are some I'm happy to use some working numbers with you, but what are some, in terms of deposits, money down and money needed, percentages or what we need for, say, I highly doubt there's going to be people that are in high quantity residential apartment space listening to this podcast for tips, tricks, and value. It's going to be more so that small to medium density band, I think, is where we can add a lot of value, because there's people there that are listening that are maybe trying to get started in some projects of that size. So what do we need to have in mind, or what do we need to know about the development space for these small scale projects?
You need to know how much money you have to contribute. And you need to know if you can demonstrate the capability of being able to complete the project. And that's not to say someone who's never done a development can't get into it. It's having the right team around you. So you need to be able to demonstrate that you have a builder that knows what they're doing, obviously, and a builder that is financially stable.
Yeah, okay.
They're probably the two key things.
Financially stable builder. Okay. Well, look, run me through this then, because if I'm gearing up to buy a site, we can call it townhouses, we can call it duplexes, or maybe it's a small scale apartment walk up. It's going to be unlikely I'm going to need to get into that. I can get into that property with a 10% deposit if I'm going down the commercial route.
Correct.
What do I need to deposit, or is that based on percentage of the gross realisation, like the sales of that development? How does that work?
So I'll start with the initial acquisition.
Yep.
There's a couple of different ways you can look at it. So if you're buying a site, there's a few different factors that will impact what the funding will look like. The first one is if there's a DA approval on the property or not. Say you're buying a house for a couple of $1 million and there's a residential property on it at the moment. If the property has a DA approval on it, then the value of the $2 million that you're paying to the vendor is attributed to some degree to the value of the DA that's on the site. So the way the lenders will look at it is they're not really looking at it as a standard residential house that you're buying initially, because they know that there's a DA and you're probably going to demolish it in the near future. So if that's the scenario that you're looking at, you're probably looking at it around a 35% deposit required, because the lenders will look at it as a highest and best use value of the property, not as a standard residential dwelling.
Yep.
On the flip side, if you're buying the same property but there's no DA, and say in the next 2 to 3 years you're looking at getting a DA over the property, then you can do it as a residential loan. They'll look at it. The lender has no idea that you're planning on doing a DA at the moment. It's just a residential house that you could be renting out for the next 3 to 5 years.
But then what's your deposit?
Probably 20%. You could probably get a 90% lend against it if you can demonstrate the servicing. Okay,
but if I couldn't demonstrate the servicing, what am I... Essentially, if I can't demonstrate the servicing, right? If I'm someone out there that's a small scale developer or starting a couple of projects, and they can't service a $2 million purchase, let's just say from your example before, are there any other ways that they can get into that market or get that purchase?
You can capitalise the interest. So say you're buying a property and your lead time to develop it is like 12 or 18 or 24 months. There are options in the market. If you have the money to contribute as a deposit that's sufficient, but you can't demonstrate the servicing, you could do an interest cap lend on the initial acquisition, which effectively means you borrow the interest within the facility and you don't have to make your repayments. And then from that point, you use that time to get the DA and roll it into construction. Is
that interest that's calculated in there? Well, like what would a deposit be on that then? Is that larger than 35%?
Yes, because you're borrowing the interest, it chews into your net funds. So if you're borrowing 65%, say 5 or 10% of that might be interest. So your deposit then goes to say 40 or 45%. Okay, so there's two options, is that you have either that large capital base to start off with, or you run it as a owner rock and take a little bit longer. But technically, I can get an option on a site, I can get a DA or a CDC approved on the site before I even own it. That will help then because the bank revalues it higher. Say you buy it under option and you don't have to settle for 12 or 18 months. In that time, if you've gone to get a DA approval, obviously there's a justification for an uplift in value. But a lender's never going to give you, say, 100% of the purchase price, regardless of how much the value's gone up. They always want some sweat equity from a developer into the project. So I would say in that scenario, hypothetically, you can borrow 100% of the purchase price based on an uplifted value of being able to get the DA in that 12 to 18 month period. You probably still need about 20% to contribute, because a lender might say, yeah, from an LVR perspective, you can borrow 100% of the purchase price, but we're actually only willing to go to say 80, 85, 90% of the purchase price, because we want to see that you have some cash available. We recognise you put the money into getting the DA, and that's fine, but they still want to see some contribution.
That's skin in the game.
Yeah.
And then what is the process then for that, for these sorts of loans to then roll into construction? Is it at the same facility? Do people need to refinance, or how does that work?
Yeah, so they're different facilities. If you've taken out a loan for the initial purchase, then when you get your DA, your CC, your builder lined up, all your ducks in a row, you then have to refinance it into a construction loan. And there are certain trigger points to facilitate that. Like I just touched on some of them, but you need to have all your approvals in place. You need to have a building contract in place. You need to have your permits to commence construction, and that can take probably, from a lending perspective, to get a construction loan approval, it probably takes like a couple of months.
And then can you talk to me a little bit about how the construction loans, how they work in terms of drawdown of funds and all right? Because I think a lot of people see the construction loan amount and then they think that they're paying, like say for example, construction loan amount comes back, you have a 9 or a 10% interest rate. I think people think that you're paying that on the full amount, but how does drawdowns and how does that interest calculation work?
So there's a couple of different ways that different lenders in the market look at it.
Yep.
Someone like a Latrobe Financial, which a lot of people who would be listening to this have probably heard of them, they do a drawn interest rate only, and what that means is their rate might be 10 or 10.5%, but it's on the progressively drawn funds as you draw them down over the course of construction. So if you get, say, for round numbers' sake, if you get a $5 million construction loan, you're not drawing the $5 million until the very end. You might be drawing, say, $100,000 a month for round number sake, and your 10% interest rate is only being charged on the cumulative balance of your loan.
Okay.
So if you look at an effective annual interest cost, it's going to be lower than 10% because it's on an average balance.
Okay, interesting. And what about line fees, setup fees, those sorts of costs? What else are sort of tacked onto these sorts of loans?
Yeah, so the major banks, for instance, they use a margin over the BBSY rate as a drawn rate plus a line fee, and the line fee is different to a drawn rate in the sense that it is drawn on the limit. Sorry, it's charged on the limit from day one. So using that $5 million example, the line fee might be 2%, but it's charged on the $5 million from day one.
Okay, and what is explain for people that are listening? BBSY.
That's the cash rate.
Okay, so they add an amount on top of that.
Correct. So the bank might take, I think the BBSY rate, and don't quote me on this because I haven't checked it in the last week, but I think it was around sort of 4.35.
Yep.
The bank will add, say, a margin of 2%.
Yep.
And then on top of that, there'll be a 2% line fee. So your drawn interest rate might be 6.35, charged on the progressively drawn funds over the course of construction, but your line fee of 2% is charged on the limit on day one.
Okay, so that 2% you're paying on the, say, $5 million for the entire length of the project.
Yep.
Okay.
So, and whether a drawn rate and line fee structure versus a purely drawn rate structure works better for a project really depends on the feasibility of the project, because it depends on how much money you're drawing down on day one. If you're refinancing a land loan and the land loan is at, say, 80% of the land value, then your starting point in the construction loan is already at a higher limit. So having a higher drawn rate probably isn't beneficial.
Okay.
Versus if you have no debt on the land, if you own the property outright, you get a construction loan for the purposes of just the construction and it's a true progressively drawn facility, then having a drawn rate of 10% is probably more cost effective because you're starting at zero to 5 mil versus, say, you have a $2 million loan on the land, you're starting at $2 million.
What are some of the other, is there any other costs or any implications that people need to consider for these sorts of loans?
You need to have developers always need to have some money available if there's cost escalations, if there's variations. You shouldn't be wholly reliant on the construction loan. That's not to say like we can't obtain loans that fully cover the construction costs and any ancillary costs, but there's always overruns. And if you think there's not, then you probably shouldn't be building.
Talk to me a little bit. Do you do much mezz finance?
Yeah, we do. So
break that down for someone that hasn't heard of that before.
So mezz finance is effectively like a second mortgage or a caveat that sits behind a first mortgagee. In New South Wales, the second mortgage, there's no requirement for consent from a first mortgage lender to lodge a second mortgage. And there's plenty of lenders in the market that play in this space. It is a delicate space, I think, as a broker.
Why?
Because of what we spoke about before, about there being sharks in the industry. That space can be quite dangerous if you don't have the right relationships. We have probably no more than, I'd say probably 3 to 5 lenders that we use in this space. Mm-hmm. And they're people that we've known for a long time. We know are very, very reputable. And then they're not going to, screw over the client.
What are the main reasons why people use like mezzanine finance?
If you need a little bit of higher leverage on a project, so say the first mortgagee is willing to go to 65% LVR on the construction loan, but the client needs probably 70 or 75, that would be why.
Okay. And the mezz loan is that calculated in the similar interest rates or?
So mezz finance typically is a fully drawn rate. So say your interest rate is 15% for the mezz loan, that's on the limit of the mezz funding that you're obtaining.
Oh, okay.
So
not the
it's
drawn
expensive.
Down. Yeah, fair.
Although in saying that, we some of the ways that we structure our projects internally is if you say you go to a private, right, and the private's charging 12% as a like internal rate of return on their money. If you're getting a stretch senior facility, which is like say to 70 or 75% LVR on the construction loan, mm-hmm. at that sort of interest rate, it's very, very expensive versus if you were to go to, say, a major bank, get 65% LVR plus 10% of mezz, the blended cost of that funding is actually going to be cheaper.
And do you calculate that
Yep.
for your clients? Wow.
So
okay.
we aim to present like a couple of different options, and we'll if they need a higher leverage option, mm-hmm. we'll present those two options and we'll demonstrate why going with a bank and a mezz option is cheaper.
Interesting. What are some of the structures you see in terms of how these developers are setting up? Like if there's people out there that don't know, that think they're going to go and run this thing in their personal name, like how are you seeing these guys or the boys and girls of the developer world set these deals and structures up?
First point would be don't do it in your personal name. It's very hard to get finance when you're building you're building on a property that's owned in a personal name. The banks don't like it. None of the non-banks like it. It just makes it like quite difficult. Most of our developers will set up, like the ones that are doing multiple projects or intend to do multiple projects, will set up special purpose vehicle entities for each project. So if you've got one in, say, Manly, you would have like Manly Project Proprietary Limited, and then the next one will be for the next project.
Mm-hmm. So never two in one project?
I mean, you can do it. There's no reason why you can't do it. It's just probably, and again, I'm not an accountant or a financial advisor. So, and everyone's...
Put that in there, yeah.
Yeah, everyone's situation is different.
Yep.
So what we tell our clients, particularly the ones that are new to it, is go sit down with your accountant and work out what the best structure is based on your financial position and your property portfolio. If you've got other properties, work out what works for you. Mm-hmm. There's no reason why you can't have multiple projects in the same entity. It's just we typically see our developers have sort of SPV entities for each project.
Okay, interesting. And what are some of the other sort of key takeaways or lessons or big learnings that you're seeing or that you can pass on to the audience that are maybe thinking about or starting projects or structuring deals? Like, what sort of insight can you give us?
My first piece of advice would probably be never go with the cheapest builder.
Yep.
I've seen that so many times over the course of my career. The client will be presented with a couple of different tenders from multiple builders. One will be significantly cheaper. If they go with that one, it is never the cheapest option. Like, it will always end up being probably the most expensive option because there's a reason why it's so different from the other options, right? That would be my first piece of advice. Don't go with the cheapest. The second would be, if you're getting into doing your first project and you need the finance, go to someone who does the development finance. So, like, you need to surround yourself with people who know what they're doing. So having the right consultants around you, being, your architect, town planner, engineer, your broker, everyone needs to be aligned with what you're trying to achieve.
Yeah, okay. What size loans are you guys doing? What are you specialising in?
I do stuff probably between like 5 and 50 mil.
Yep.
But that's not to say like the initial purchases and stuff that I do for some of my clients are like in the sort of 1 to 5 mil space as well. But yeah, we don't have a cap. Some of the loans that we've done have been in excess of 100.
What's the biggest one you've done?
Me personally?
Yeah.
I think it was 48. Yeah.
Resi site?
Yeah, it was in Box Hill. It was like 91 apartments.
Wow. Okay. Interesting. In your career today, what has been the most difficult part or the lowest part of it?
There's a couple of different...
Yeah. Tell me.
So I'm obviously a young female working in the development finance space. That's been really challenging. There's a lot of people who probably don't see me as being the person that you would go to for, say, that 91 unit development in Box Hill.
Yep.
And I've had to tackle having major imposter syndrome throughout my career because I also am like, why would you come to me? Like, I don't get it. But so that's been really challenging, but it has also made me more driven to, prove people wrong.
Yeah.
The second thing that's been really challenging is just, and for me personally, is this year has probably been the hardest year of my career. I had a developer client that has been a long-term client of mine. He actually went under a couple of years ago and he got investigated by ASIC. And so I got brought in as a witness to ASIC to, help them build a case against him this year. And that was really, really terrifying, to be honest. As I kind of looked in the mirror and I was like, I'm too young to be going through this. Like, I've only been in the industry for 7 years, which I know is not an excuse. Like, this can happen to anyone, but it's kind of just a reflection of where the market's going a little bit.
Mm-hmm. And what is so these awards? When do they come in the 2020s? What's the, how do you get them? Is that something that you saw and you work towards, or how do they play into the picture?
So I'm very fortunate with working at Simplicity because the directors that own the business have really helped me push, my brand out there. And so they've been very, very supportive. They've been encouraging me to enter these awards and, very supportive in me doing this. So I definitely didn't think I had a chance of winning any of them. But, it's been like the awards. Look, people probably have mixed opinions on them because there's so many different ones. There's so many different categories and everything. And to be honest,
there is in the broker space for some reason.
I know. It is kind of a little bit ridiculous. I'm very, very grateful for like being able to, be nominated and be a finalist and be a winner for some of them. But it's not actually the award that I really care about. It's the reputation and it's the ability to get my name out there, get my brand out there. That's what's actually invaluable.
Where have you built your brand the most?
Like on social media?
Yeah.
I'm honestly terrible at it.
You're not meant to say that.
I know, but it has been an ongoing goal of mine every year. Build your LinkedIn brand. And I don't get around to it enough. So I need to do that. That's going to be my goal for next year.
Yeah. Okay. Let's start now with the podcast into November, December 2024 and then into 2025. What advice would you give if there is other young female brokers out there that are looking to enter the development or commercial or even broker space?
There is a lot of women in the resi broking space, but I think it's probably just scary to get into the commercial, and I completely get it. I really fell into it, and I don't know that I would have actively, like, I love my career, don't get me wrong, but if I was thinking about it as a career opportunity, it probably would have been a much more difficult decision. So my advice would be just, don't be scared, and like, you don't have to do it all at once. Commercial can be really overwhelming, as I said at the beginning. Just, dip your toe in. Find something that... What I love about the construction space is I actually have a genuine interest in it. And I don't do asset finance. I don't do some of the other aspects of commercial because I'm not really, like, invested in it. I really love the construction space. So my advice would be pick an area in commercial that you're interested in and just start there. You don't have to do it all at once.
Okay. Who's been your biggest lean on or your biggest mentors? Is that your current bosses now?
Yeah, JP and Matt, who started the business, have been, my biggest supporters the whole way through. They've literally helped me build my career from the ground up. So yeah, definitely them.
Is there anything else that we've missed that you think is worth discussing or mentioning in terms of commercial finance in the development space?
There's a lot of liquidity in the market for construction and commercial finance. We're seeing a lot of demand from the lenders. They want to do these deals. Mm-hmm. So if clients are going into this thinking it's going to be difficult getting the finance, if you have all your ducks lined up, there's a lot of options out there.
What are our main ducks that we need lined up in order to look in the bank's best eyes?
You need to know how much money you have to contribute and be confident that you can meet their LVR requirements.
But apart from deposit, I've got the deposit. Yep. I come to Izzy. I want to do a deal. Is there anything I can put together that will demonstrate to the bank and give them reassurance that they can lend me the $5 million to complete the project? In
the construction space, I would say just being really clear on who your consultants are around you, and then also the amount of people I have come to me who are wanting to build something and they don't know how to put a feasibility together. That tells me that they don't really know what they're doing. And I'm not saying anything fancy. You can literally put something together in Excel. So just knowing what your numbers look like, that is one way to weed out the people that know what they're doing versus the people that don't.
Yeah. Okay. Would you say that's the main mistake people are asking or people that are making when they come to you?
Yeah, definitely.
That's the biggest mistake? Anything else that comes to mind? Knowing your numbers, know your deposit, but are you seeing any areas at the moment in the market? I know you do across Australia, but are you seeing any areas where the people are making the most money? Or
look, the construction industry has been hard over the last few years, and it's definitely weeding out the really good developers from the ones that aren't as strong. But I think just having unrealistic expectations also is one of the biggest hindrances, particularly around, timing to get approvals. Like if you buy something that's not DA approved, for instance, and you think you're going to have it done within 12 months, you're probably not going to. If you haven't lodged anything to council, that's the biggest message that we're hearing from all our developers. Everything is so slow.
Depends on the size of the project, right? Because a duplex is going to be quicker than...
Yeah.
Okay. Well, look, that's something to keep in mind. I think we've covered most of it. I know we've covered a lot of points, but we've covered sort of the lowest and the biggest challenges. How have you got through them?
I was actually thinking about this morning because I'm a very, very avid podcast listener. And I listen to a few particular podcasts.
Give him a shout out.
Jay Shetty's podcast and Alex Cooper's podcast. I love her because she's a businesswoman who's really building her brand.
Yeah. No property ones?
There's a few here and there, but honestly, they're more like...
Jay Shetty with purpose, or on purpose, I think it is,
I heard a quote the other day. I can't remember exactly what the quote was, but it was something to do with you always get through it. So and this is so relevant to what I do because some days
is this going to be, if I ask you a quote you live your life by, is this going to be it?
Yeah, probably.
Okay, well I'm going to ask you that because I don't want you to double up. So look, Isabella Constantinou, tell me, what is a quote you live your life by?
It would be, you always get through it, and it's related to, whether you're going through stresses in work, your personal life, whatever it is. If there's something that's really, really making you stressed, making you anxious, making you scared about something, you're going to look at that in 2 days, 5 days, 7 days from now, and it will all be okay. So, you always get through it. You've gotten through it to date, and you will get through it.
Nice, I like that. And what's been the best bit of advice you reckon you've received in your career so far?
Oh, that's a tough one. Do you know what's funny? The one that comes to mind is one of my coaches when I was horse riding. He gave me the advice, just let it happen. And I really like that.
What do you mean?
Just don't, like, obviously work hard for what you're trying to achieve, but things will happen. Just let them happen.
Yeah.
Okay. And I like that.
Cool. Well, look, that's an interesting one. I haven't heard that before, but it kind of makes sense, right? Rather than trying to force everything. Any closing thoughts or anything like that?
There's one thing I wanted to mention.
Yeah.
Something that is obviously very evident from, like, in my career, because I've only ever worked at Simplicity really straight out of uni. Your reputation is always more important than your resume and your qualifications. And I think that's really important to remember. That's
a good one. Yeah, reputation takes years to build and sometimes minutes to lose. So, look, Izzy, appreciate you coming on the Everything Property podcast, and hopefully some key takeaways for some developers or future developers out there.
Thanks for having me.
No problems at all.